Peter Rose, Longwood Currency Trading. Surviving statistical losses in your Forex trading is the topic that I want to cover for you today. It's a critical topic and you really need to understand it because there's more to it than just statistics. But first, we're going to go outside because I just got back from meeting Sue. She had taken the bow dog out for a walk and she wanted to move on and go somewhere else. And so I went down and picked him up, and it's such a beautiful day. We're going to go outside and see you today. It's a beautiful early August day, 2022, and we're supposed to get some rainstorms later tonight, actually today, and we need it because you can see some of the grass is a little browned out. My channel is primarily directed at the 21 to 34-year-old age group, trading account sizes of 4 to 5 figure account sizes, and not having the skill yet to have the confidence that, well, what would I do if I ended up with a 6-figure account? Because someday, if you're successful, you may very well end up trading that 6 figures, and so it's really important to understand how to make those transitions. And so this channel is trying to provide a framework for those folks. My course that consists of 4 different course books at different levels, tries to walk you through this stuff, and the videos that I do try to be helpful in different areas that you need to be aware of in your trading if you decide, you just don't want to spend the money or take the time to listen to me in a course environment or consulting environment, and that's fine. I'm not in this to build a trading business. I want to work with just a few people a year and make them successful, give them the tools to be successful. I can't make you successful. I'm not a freaking wizard. You're the wizard. You have to take the skills that somebody gives you and or shows you how to implement and make that work. I mean, that's just the way it is. So this topic of statistics and probability plays a huge part in your understanding of what's going on with you in the currency markets. As a currency trader, we trade a lot. If you're trading stocks, your statistics and probability calculations are going to differ than they would in as a currency trader. Statistics and probability are all based on the law of large numbers. And if you're doing stock, unless you're day trading penny stocks or something, I mean, I'm not a stock fan anyway, because the only thing you have to go by on stocks is 10K reports and what people say about it, and it really holds very little validity for normal people. You have to really know a lot about the individual companies and what's going on in order to risk your money in that. You would think that would be the case in currencies, but because you have an enormous market, almost a $7 trillion market out there, and tremendous liquidity, particularly in the 6 major or 7 major or 5 major currency pairs that that are out there, you have what's called a large sample size. You have a large sample size of not only products as far as currency pairs, but because of the leverage and that liquidity, you take advantage of that leverage and liquidity and you trade a lot. And because there is that liquidity and because there is that diversity, you're able to get in there and trade many times, maybe a day or many times a week, more so than you would if you were just kind of getting into stocks or futures or something like that. The liquidity provides more of a probabilistic price action movement than it does in the stock market, because the currency market is based on the economies, or the perception of those economies, or the actual client order flow between those two countries for economic conversion is so huge that the statistics really work, and they're very probabilistic. I don't know whether that's kind of redundant or not, but regardless, you don't have to know anything about statistics or probability to trade currencies. You have to know the principle of it, the same way you would if you were playing poker, right? I mean, you'd have to know that if you suspected somebody was holding trips and you were sitting there with a high ace looking at an 8 on the river or something to pair off the 8s that you have, you're not gonna go to the river, right? So when you're looking at a statistically rich environment, that gives you an edge right away. But as statistics can work in your favor, they can work against you too. If you trade enough, and I can get into the mechanics of what enough is to cause these statistics to trigger off at different values. But if you trade enough, and based on your win-to-loss ratio, there's a statistical likelihood that within 300 trades, you're going to hit 6 losers in a row. That can go up to as little as 200 trades. Now, that doesn't sound very bad. 6 losses in 300 trades in a row. Yeah, but what if you're trading with size, and you're trading at $200 a pip, and your stop is 20 pips out, just as a random thing, and you lose that 6 times in a row. Statistically, you're within margin. From a pip balance, you're you're okay. From the amount of money that you have lost per trade based on the size of the bank, if you're at $200 a pip, you got a $200,000 account. That's not a huge loss at all. Everything is great, except the dollar value. You have to realize that if you, as another statistic, if you lose 50% of your account, then on the remaining balance, you have to earn 100% just to break even. Now, if you're having a hard time making 30% a year, how do you figure you're going to make 100% in 10 years, right? I mean, let's get realistic about your risk. And that's really, the risk is not so much what you do as a totality of the risk that you're taking, but you're also assuming the statistical risk of trading. At some point, you're going to lose 6 times in a row. It gets worse than that. The statistics say that basically no matter what you do over the long term, over a large sample size of trades, on average over that large sample size of trades, you're going to lose 6 times in a row. You're not going to be able to avoid that. It's just like you're not going to be able to win every hand of poker or avoid having a flat tire in your car. That's just the way things are. You're going to lose 6 times in a row. And everybody says, oh, okay, I'll just have to eat it and deal with it. Yeah, okay. But the statistics are only about 25% of that. What happens to you psychologically when you lose 3 or 4 times in a row? Don't you get a little aggravated? Don't you get a little pissed off? My wife Sue and I play backgammon almost every night. Have a glass of wine, play some backgammon, trash talk each other. We have a great time. We probably play 2,500 games a year. And it's not pro level or anything, we just enjoy it. But we do get heated sometimes in the activity. And I'm very heated right now because I've lost 11 days in a row without a winning day. She's starting to feel sorry for me. I'm starting to feel sorry for me. And so when I get up there to play and I throw the dice, I take stupid risk. I just, you just say, this can't go on forever. You're right, the statistical losses can't go on forever. But when I exacerbate the situation by acting like a dumb shit, they could go on forever. When you start losing several times in a row, you're not going to think, unless you're experienced, that it's statistics, or maybe that it's even your fault. You're going to blame it on your methodology, your trading system, I don't know, the day of the week. You're going to make excuses. And then when you hit those you get to 5 losses in a row, or you get to the 6th, and now you're beside yourself with angst. And what are you going to do? You're going to try to swing for the fence the next time to make that up. Or you're going to let that trade run, that position run against you because, well, it's got to turn around at this point. I've been wrong 6, 8 times in a row, and so it's got to turn around at this time. And so now the losses begin to magnify themselves, and all of a sudden you find yourself with a 20% drop in your account or a 30% drop in your account. Look, this is what happens. Your discipline goes to shit when the statistics manifest themselves in those, what you would call anomalies or black swans. They're not anomalies and they're not black swans. They're statistical likelihoods. You can't lose if you're predestined to be on a 6 loss in a row, and you hit 4 losses in a row, and you say, you know what, I'm just going to quit trading for a while, and I'll pick this up next week after I get back from a vacation in Carolina, and then I'll get to restart the clock. No, you're not. You're not going to restart any clock. There isn't any clock. The great watchmaker from the Matrix keeps your clock right in tune with everything that's going on. You're going to lose again a couple of times, and that's really going to piss you off because you thought you reset the clock, but it's not. I'm just trying to give you a view as to how the mathematics, the statistics, the probabilities are so deeply interwoven into your psychology that you can't ignore the psychological aspects of your study. I do videos, and if I put psychology on the title of the video, nobody watches it. If you read a video that says psychology or has to do with psychology and you don't watch it, you're an idiot. The psychology is more important than what you do on the technical side, because if you learn to trade correctly, it's all based on statistics and probability. It has nothing to do with your skill. The skill lies in understanding probabilities and taking advantage of them based on your knowledge of your trading metrics as to where your edge is at dealing with certain things. For example, you may be a better long side trader than a short side trader, and so you use that to your advantage. You might feel that you're a better trader on a Friday or a Tuesday, or you're a better trader with Canadian-based currencies. I don't know what it is that your edge is. There are so many edges. That's why I don't teach stuff like that in my courses. I don't teach edges. I teach what an edge is and how to deal with it and how to maximize it based on general statistical and probabilistic principles based on rules that are not static, but they're what I call in my third course, process-oriented rules, so that you're not, if you're trying to learn a language, you don't look at the dictionary for the words to say. You have to have somebody give you the word. Where's the bathroom? You know, ¿Dónde está el baño? Oh, okay, now I know what that is. And then after the fact, you figure out that donde is where and baño is bathroom. That's how kids learn language. You have to learn the currency trading the same way, because that's the way our brains are wired up to work. Man, it's really nice out here. I'm wandering around and the camera's going all over the place. And you know what? I need a cup of coffee, and so that's it. Surviving statistical losses in Forex trading is not only based on the statistics, but it's on your psychological ability not to go off tilt when you hit those statistical probabilities. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.